In this video, we are going to learn about capital gain, theoretical concepts of capital gain. Okay, so before we start, let us try to understand what is gain. Gain. Gain is nothing but a profit. So, capital gain is nothing but a capital profit. So, how do you get this capital profit? If you sell any of your capital asset, then you might get capital profit. That is termed as capital gain. Now, what do you mean by capital asset? Capital asset could be a fixed asset like land, building, plant and machinery, motor vehicle, or could be an investment like investment in shares or debenture. Right? So let's start. Point number one. Capital gain or loss is the gain or loss which is computed on the transfer of a capital asset which is chargeable to tax. Now there are two words which are important here. One, this transfer, and second, capital asset. So they are saying capital gain or loss is the gain or loss which is computed on the transfer of a capital asset. So let us try to understand what is capital asset. Anyways, we know what is capital asset. Capital asset is equal to fixed asset and or investment. But there is a section for capital asset, section 2 subsection 14. So capital asset is defined under section 2 subsection 14 as per Income Tax Act 1961. So let us try to understand this definition. It says capital asset refers to any property excluding the following specified asset. Now let us try to understand which property is excluded from capital asset. The first property which is excluded from capital asset is so closing stock is excluded from capital asset. Why it is excluded from capital asset? Because closing stock is a part of current asset. Here we are talking about fixed asset. Hence, closing stock is excluded from capital asset. Second property which is excluded is personal effect. Any property which is having a personal effect. For an example, that is movable or movable property for personal use. So if you got a property which is movable in nature and you got a personal effect in that property, you use that property for personal purpose, so it is excluded. For example, you got a car or a bike which you use for personal purpose. It is movable and it is personal in nature. Hence, bike or a car which you use for personal purpose is excluded from capital asset. But jewelry is considered to be a capital asset. Jewelry, even though it is personal and movable, but still it is considered to be a capital asset. Third property which is excluded is agricultural land. If you got an agricultural land which is situated in rural India, it is also excluded from capital asset. And remaining, if you see, all are bonds. 6.5% gold bond 1977, special period bond 1991, gold development bond 1999, 7% gold bond 1980, national defense gold bonds 1980. So three or four type of properties excluded from capital asset. The first one is stock in trade, that is closing stock. Second one is personal and movable property is excluded. Third, agriculture land situated in rural India is excluded. And fourth, all bonds. Now, if you read the first point once again, it says capital gain or loss is the gain or loss which is computed on the transfer of a capital asset. So we have understood what is capital asset. Now let us try to understand what is transfer. Transfer is also defined under section 2 subsection 47 and as per Income Tax Act 1961. Transfer includes sale, that is in rupees or in any monetary form, exchange in kinds, barter exchange, relinquishment, that is surrender. B. Compulsory acquisition. Now, what is compulsory acquisition? If government compulsory acquires land from you, so it is again a transfer. Conversion of capital asset into stock in trade. Now, what is capital asset? Fixed asset. And what is stock in trade? It's a closing stock which you take under the head current asset. So what you're trying to do, you're trying to convert your fixed asset into current asset. But why you're doing this? You wanted to save your tax, and that was possible. Okay, so because of this, government came with this concept called conversion of capital asset into stock in trade. Now if you try to convert your capital asset into stock in trade, it is a transfer, and you will be liable to pay capital gain tax. Next, possession of immovable property on transfer. So if you book a flat in the under construction building, residential building, once the flat is ready, builder will give you the possession of that flat. So that is again a transfer. Builder is transferring the property on your name. And the last one is enjoyment of immovable property. If someone stays in your property for a longer period of time without any agreement, without any rent agreement, then it is as good as transfer. Right? So this is the definition of transfer under section 2 subsection 47. Let us go for the next part. Now if you talk about capital asset, there are two different types of capital asset. First, short term capital asset. Second, long term capital asset. So two things you will have to remember: the cutoff dates for these assets. There are two different class of assets or category, you can say. The first category is shares or debenture, and the second category is other than shares or debenture. So the cutoff for shares or debenture is 12 months, and the cutoff for other than shares or debenture is 36 months. Now what do you mean by cutoff? In case of shares or debenture, if you sell it before or within 12 months, it will be treated as a short term capital asset. For example, if you buy a share today, if you invest in shares today and you sell the same shares within 12 months from the date of purchase, then it will be treated as a short term capital asset. If you sell the same share beyond 12 months, then it will be treated as a long term capital asset. So that is why we say the cutoff for shares or debenture is 12 months. In case of other than shares or debenture, the cutoff is 36 months. Let us take an example of house property. House property is an asset which is other than shares or debenture. So if I buy a house today and sell the same house within 36 months, then this house will be treated as long-term capital asset. Sorry, short-term capital asset. And if I sell the same house beyond 36 months, it will be treated as long-term capital asset. So for property other than shares or debenture, cutoff is 36 months. Now in case of shares, for unlisted shares, cutoff will be 24 months. Okay. So as we have understood short-term capital asset and long-term capital asset, now let us try to understand how to calculate this short-term capital gain or long-term capital gain. Now, when you're going to have this short-term capital gain, if you sell your short-term capital asset, two possibilities of short-term capital asset. In case of shares or debenture, less than or within 12 months. In case of other than shares or debenture, within 36 months, if the asset is sold, it will be treated as short-term capital asset. And if you generate profit on such sale, it will be termed as short-term capital gain. When you're going to have long-term capital gain? If you sell your long-term capital asset. Two possibilities. In case of shares or debenture, if you sell it beyond 12 months, it will be treated as long-term capital asset. And in case of other than shares or debenture, if you sell it beyond 36 months, it will be treated as long-term capital asset. So if you sell any of the long-term capital asset and generate profit, it will be termed as long-term capital gain. Now let us see how it is calculated. If you want to know profit, so there are two ways to calculate profit. The first one is income minus expense. And the second way is selling price minus cost price. Depends what you are selling, right? If you're selling your product, so you will take income minus expense to know the profit. Wherein if you're selling your asset, in that case you will take selling price minus cost price. So now we are talking about asset, hence here we are going to take selling price minus cost price. So let us take an example. So I got a house of 30 lakhs. The cost of this house is 30 lakhs and I'm selling the same house for 35 lakhs. So in this case, my selling price is 35 lakhs, wherein the cost price is 30 lakhs. So my profit will be 5 lakhs. So let's see what is full value of consideration. It is your selling price. So 35 lakhs will come here as full value of consideration. That's my selling price of the house property, right? Now the next is less expenses on transfer. Sometimes what happens, we are not able to sell the house on our own or we don't have time, so we go to the agent. So we sell our house via agent. Now agent will charge, he will take his brokerage, so that will come under expenses on transfer. So that also you can subtract from your selling price to arrive at the profit. Then the next thing that you will have to subtract is cost of acquisition. This is nothing but your purchase price. So in our example, selling price is 35 lakhs, cost price is 30 lakhs. So 30 lakhs will come here as cost of acquisition. The next is cost of improvement. Cost of improvement also you can subtract from full value of consideration. Now what do you mean by cost of improvement? See, whenever we buy a house, we never enter into that house as it is. We make some improvement in it. Maybe for like flooring, we change the flooring, we do painting, or we do POP, or any other expense we do. We renovate it and then we enter into that house. So that will come under cost of improvement. So that can also be subtracted from full value of consideration. So after subtracting all this thing from full value of consideration, you will get short-term capital gain. Right? Now let us try to understand how to calculate long-term capital gain. If you see, more or less the format is same. The first thing that you will have to take is full value of consideration. Second is expenses on transfer. Third is index cost of acquisition. Now what is new over here? New is indexed. In case of short-term capital gain, there is no indexed. But in case of long-term capital gain, there is indexed. So there is an indexation. So instead of taking cost of acquisition, we will take index cost of acquisition. Now what is this indexation? This is cost inflation index. So with the help of this indexation, what happens? Your cost goes up and profit comes down. And this indexation benefit is available only for long-term capital assets. It is not available in case of short-term capital assets. For an example, if you buy a house, let's say in 1967, and you're selling the same house in 2017. So definitely you must have bought this house at very cheap rate, because in 1967 the cost of the house was very low. In fact, I can say the inflation was very low. Now because of this inflation, what happened? The cost went up. So if you want to sell this house, you will sell as per the market rate or the market value. which will be high. So if you want to know profit, so in this case selling price will be very high, wherein the cost price will be very low. Why? Because you bought this house in 1967, and that at that time the cost was very low. So in such a situation, profit will be very high. Hence, indexation comes in the picture, and indexation says you don't have to worry. Because of indexation, the cost of acquisition will go up. You will be able to convert your old value or the old cost into the new cost. That means cost goes up and profit will come down, right? So that can be subtracted from full value of consideration. Same way, index cost of improvement can be subtracted. So once you subtract all this thing, you will get long-term capital gain. Next point, there are few cases where fair market value will become sales consideration, because sales consideration will be zero. Hence, we consider market value or fair market value as the sales consideration. For an example, let me take you to the point number E, asset transferred by way of gift or bill. Suppose if somebody is transferring you the asset, okay, suppose if I transfer an asset to you by way of gift, so I'm gifting you an asset, right? So definitely I'm not going to take any money from you. Why? Because it's a gift. I'm giving you I'm giving you a gift, so that's free of cost. So in such a situation, if I want to know the profit, I'll have to do the same concept, same equation, selling price minus cost price. In this case, selling price is zero, wherein the cost price is 30 lakhs. Let us take the same flat. The cost price is 30 lakhs and selling price zero. So you will get negative 30 lakhs, minus 30 lakhs, right? Because you don't have selling price. That's why we have this concept called fair market value is equal to sales consideration. Now, in this case, what happens? Whatever is the market value on the date of transfer by way of gift, that will become the sales consideration, and that will be subtracted. You will have to subtract the cost of acquisition from this fair market value. So you will get the profit, right? So these are the situations or cases wherein fair market value will become the sales consideration. Capital asset is transferred into stock in trade. So again here you will not get selling price. In such a situation, fair market value will become the sales consideration. Distribution of capital asset by firm, AOP, BOI, barter exchange, asset distribution in kind of liquidation, and last one, asset transfer by way of gift or bill. So remember one thing, in this cases you will not get selling price. Selling price will be zero. But we cannot calculate profit if you don't have selling price. Hence, government says that fair market value or the market value on the date of transfer will become your selling price or sales consideration. And accordingly, you will have to calculate the profit. Right? Let us move on to the next concept, expenses on transfer. Now, as we know, there are expenses on transfer in the format for calculating the short-term or long-term capital gain. So which all expenses you can show under the expenses on transfer? The first you can show is brokerage and commission. Second, cost of stamp. Third, registration fees borne by vendor. Fourth, traveling expenses. Fifth, litigation expenses. That is expenses on registration of shares. Next concept, cost of acquisition. Now this is your cost inflation index as per the Income Tax Act 1961. So we will have to follow this CII. Now if you see this, it starts from 1981-82. So 1981-82, the CII is 100. So we have assumed, as we have started our cost inflation index from the year 1981-82, we have assumed this year as the base year, and hence we are taking 100. Now based on this, if you see, as the inflation went up, our cost inflation index also is going up. So if you see all the years, cost inflation is increasing. That's because of the inflation. So in the year 2016-17, so 2016-17 is our previous year, the cost inflation index is 1125. Next concept, cost of previous owner under section 49 subsection 1. Now what happened, I hope you remember in one of the example, I have gifted one asset to you. I have gifted one property to you free of cost by way of gift, right? So for me, selling price will be 0. Same way for you, cost price will be 0. Suppose if you sell the same property to somebody else, so in that case, you are going to have the selling price. But what about your cost price? Your cost price is 0 because I have gifted that property to you, and that too free of cost. So for you, cost of price will be 0, but you will have selling price on sale of such property. So selling price minus cost price will give you profit. Cost price is 0. That means the whole selling price will become your profit. So that means you will have to pay a huge amount of tax. So just to avoid this, government came with this section called cost of previous owner under section 49 subsection 1. Now what happened in this case, there are few cases wherein your cost will be 0, then whatever is the cost of the previous owner, that will become your cost, and that is possible because of this section 49 subsection 1, right? So in your case, what will happen, you will have selling price but your cost price is 0. So whatever is the cost price of the previous owner, that means my cost price, that will become your cost price, right? So you don't have to pay more tax in that case. So which are those situation or cases? The first one is asset received by gift or will. Second, partition of HUF. Third, transfer of asset to the partner on dissolution. Fourth, transfer of asset on liquidation of the company. Fifth, transfer of asset on amalgamation of a company. Sixth, transfer by a holding company to Indian subsidiary company. Seven, transfer by a subsidiary company to Indian holding company. Eight, transfer by trust. So these are the situations wherein cost to the owner is 0. Hence, cost of previous owner will be deemed as the cost of the owner under section 49 subsection 1. Let us move to the next concept. Cost of converted shares or debenture under section 49(2)(a). Now, if you want to know the cost of converted shares or debenture, you will have to do this equation. You will have to take the value of debenture before conversion, subtract the value of debenture after conversion. So automatically you will get cost of acquisition of shares. Next concept, cost of acquisition in case of depreciable asset under block method. Now, what do you mean by block method? We are aware of depreciable asset. I hope you know what is depreciable asset. The asset on which you can calculate depreciation, like uh, building, plant, machinery, motor vehicle. All these are depreciable asset. Now, what they are saying, cost of acquisition in case of depreciable asset under block method. Now, what do you mean by block method? Because we know about straight line method, WDV method, or you can say reducing balance method or fixed installment method. Now, what is this block method all about? So this there is a separate way of calculation for depreciation as per Income Tax Act. Income tax never follows straight line method or WTV method. Income tax follows only block method. For an example, if you got a machine, let's say machine number 1, and the rate of depreciation for machine number 1 is 10%, so it will go into block number 1. You purchased one more machine number 2, the rate of depreciation is again 10%. So that will again go into block number 1. You're buying third machine, right? You already have two machine, you're buying third machine, machine number 3, the rate of depreciation is 7%. Now in this case, if you see, the rate differs. Already machine which you have, let's say machine number 1 or machine number 2, the rate of depreciation is 10%, wherein the new machine, machine number 3 which you're buying, the rate of depreciation is 7%. So this machine number 3 will go in block number 2. Why it cannot go in block number 1? Because block means wherein you can put same class with same rate of depreciation. Same class of asset with same rate of depreciation will go in one block. Right? So if you have different class or different rate, so you will have to put that particular asset into next block or any other block. So now in our case, in our example, machine number 1 and machine number 2 is in block number 1, wherein machine number 3 is in block number 2. Now why machine number 3 is in block number 2? Because rate is different. Machine number 3 is depreciated at the rate of 7%, wherein machine number 1 and 2 will be depreciated at the rate of 10%. Now suppose if you are buying furniture at the rate of 10%. Now can you put furniture in block number 1? No. Why? In block number 1 you will have only machine at the rate of 10%. So that means you will have to create third block, block number 3. So in block number 3 you will have furniture at the rate of 10%. Now why we are not able to put furniture at the rate of 10% in block number 1? Because class of asset is different. In block number 1 you have machinery, wherein in block number 3 you have furniture. So what do you mean by block? Block is an asset with same class and same rate of depreciation. So that is how depreciation is calculated as per Income Tax Act. So once you have added all this, you have created all this block, later on towards the end you will have to take the total of all the blocks. Like let's say block number 1, take the total of block number 1 and then calculate depreciation at the rate of 10%. Then next take block number 2 and then calculate depreciation at the rate of 7% on the total of block number 2. Block number 3, take the total of block number 3 wherein you have furniture at the rate of 10%. So after calculating the total, take the depreciation at the rate of 10% on the total of block number 3. So that is how depreciation is calculated. Right? In this scenario, there are two possibilities. If you might have sold all the assets in the block, this is the first possibility, that is case number 1, all assets in the block are sold. Or there are possibilities wherein you have